The stock market is the most accessible way to build wealth, but most of us are never taught how to invest our money in stocks.
Right.
So what I want to do today is break down everything you need to know when it comes to investing your money in stocks. Let me actually go over this. So what I want to talk about is first lay the foundation of what is a stock, what is the stock market, what are the different stock market indexes, the Dow Jones, the NASDAQ, the S&P 500. I want to go over everything, going over the foundation of the stock market, that we're all on the same page. Then I want to go over how do you actually make money in the stock market. So this goes into how do you first come up with a stock market strategy? What's the difference between trading stocks and investing stocks? Now when we're talking about investing in stocks, what are the different strategies there? You have an active strategy and a passive strategy. We'll talk about ETFs, mutual funds, individual stocks. Then I want to go over how do you actually analyze a stock? This is where things get fun, because now you need to know, how do you know if a stock is undervalued or overvalued? How do you know if a stock is worthwhile to invest in? So we'll talk about things like the PE ratio. We'll talk about 10Qs and 10Ks to find the information that you need. We'll talk about how to analyze a company's cash flow statement. So we'll go over all of that when it comes down to analyzing a stock. Then we'll talk about how to actually buy a stock. So this is going to be things like, which brokerage do you use? How do you find a good and reputable brokerage? What do you do when it comes to market orders and limit orders? And what about taxes? Because you got to worry about taxes when it comes to investing your money. And then finally, I'm going to wrap up by talking about some of the mistakes that you do not want to make, because especially if you're a newer investor, you never invested your money before, you need to know how do you actually make money over the long term, because what happens to a lot of people, I've been in the same position, you start making some money, you think you know everything, and then you go and do some dumb things, and then you lose all your money in the market. So let's jump right into it with number one. What is a stock? What is the stock market? Why does the stock market exist? The stock market exists as a place for you to go out and invest your money into these publicly traded companies. So you have two different types of companies in the world. You have public companies, then you have private companies. The minority mindset is a private company. So if you wanted to go out and invest in minority mindset, you'd have to ask the owner of minority mindset. In that case, that's me. And you'd have to say, hey, Jasprit, I want to invest in the minority mindset. And we have to come up with a private deal for you to get ownership in the minority mindset. But a public company is a company that anybody, the public, can go out and invest in. So for example, McDonald's. McDonald's is a publicly traded company. So if you want to go out and become one of the owners of McDonald's, you want to invest in McDonald's, you don't got to go call up the CEO. You can just go onto the stock market, buy one share of McDonald's. And when you buy one share of McDonald's, you become one of the shareholders of McDonald's. Now, when you have one share of McDonald's, you don't get to tell McDonald's what to do. You do get voting rights, but you're not going to have to go and flip burgers. You're not going to tell them what to do. You just get to share in the profits when McDonald's makes money. And we'll talk about how you make money shortly. But when you go out and you invest in a company, now you become one of the owners of that company. So it's a way for you to shift your mindset from the consumer mindset to the producer mindset, because before you're just consuming McDonald's, you're eating those nasty burgers. But now when you become the producer, you own a share of McDonald's. So now you own a piece of the company. So when McDonald's makes a lot of money, you get to share in the upside because now you own some of that company. Now the question is, why does this exist? Why do companies want regular people like you and me to go out and invest in them? Well, there's a couple reasons why. The first reason is when it comes down to just money. Because let's assume that you're a startup company. You have this idea to create a guacamole company. You have this great guacamole recipe, and you start making it out of your kitchen. You start making guacamole and you start selling it to your friends and your neighbors, and people really like it. And they're like, you should go and sell this in stores. So you say, okay, you take your guacamole recipe, you go to Whole Foods, and Whole Foods says, okay, we'll start selling your guacamole. Now you start getting some bigger orders. Now in order for you to fund these bigger orders, you might need to go and hire some people. You might need to hire a commercial kitchen. And if you don't have all the cash in your pocket, you might need to go out and get some debt or go out and get an investment from your friends and your neighbors to go out and start funding these orders. So now you raise a little bit of money to go out and start funding these orders. And then Kroger says, hey, can you start selling guacamole here? And then Costco also says, can you start selling guacamole in our stores? Now you start to get more and more orders. So now you might go to a venture capital company and raise $10 million. That way you have money to go hire more employees, open a bigger commercial kitchen to create more packaging. That way you can fund all these orders. So now you have all these orders going out, and you're starting to grow, and now you have new business ideas. You want to create new guacamole lines, you want to create guacamole apparel, you want to get into restaurants, you want to do all these different things, but you need more money in order to do that. And eventually you're going to hit a point where it doesn't make sense for you to keep raising debt. It doesn't make sense for you to just keep getting money from venture capitalists. So what do? Well, now you can go onto the stock market, because it's an easier way for you to access a bigger pool of investors, because you have millions of people that are buying and selling stocks in the stock market. So the stock market is a place now for you to go and raise money from the broader public. It's easier for you to raise money. And second, you also get publicity. You get PR, because it's a way for you to legitimize your company. So now if you go to the stock market, you go ring the bell in the stock market because you're trading on the stock market, your guacamole company is going to get a lot of publicity. Because now you can go to the media and say, this local company that started out of my kitchen is now going public on the stock market, and anybody can invest in it. And if you like this guacamole that you're eating, you can be one of the owners of the company as well. So it's a way for companies to get PR. It's a way for companies to raise money. And it's also a way for them to cash out their early investors. So the early friends and neighbors that invested money into the company, they were just holding onto stock. They were holding onto some ownership in the company, but they can't sell it because it's a privately traded company. They have no one who wants to buy the stock yet. It's very difficult to do that. But now when it's publicly traded, the early investors now have the ability, if they want to, they don't have to, they have the ability to sell some or all of their shares if they want to. So that's why the stock market exists. It's a way for companies to raise money. It's a way for companies to grow even bigger, faster, because now this guacamole company has more cash in their hand. When they got more cash in their hand, they can go out and invest in more operations. They can invest and hire more employees. They can invest in more growth. That way they can grow bigger. So now when it comes to the actual stock market itself, lots of people come up with different indexes, different ways to understand what's going on in the stock market. So if you go onto any financial news website, you go onto CNBC, you go onto the Minority Mindset News YouTube channel, you go onto Finance, Yahoo, everyone's going to talk about things like the Dow Jones, the NASDAQ, the S&P 500. These are different indexes in the stock market. You could think of an index kind of like a group of stocks. It's just a basket of stocks. And it's a different way for you to understand what's going on in the stock market. And all they're trying to do is give you a broader picture of what's happening in the stock market and kind of in the economy. So the Dow Jones is a list of 30 different companies. I'm going to write this down so it's easier to understand. So you have one, the Dow Jones. So the Dow Jones is broken down into a group of 30 big blue chip, I'll talk about blue chip is in just a second, big companies in the stock market. So this is kind of a small little subset of stocks on the stock market, and this kind of gives you an idea of what's going on in the market. So this is one of the most commonly referred to indexes where people say, oh, the Dow Jones went up today or the Dow Jones went down. It's supposed to give you an idea of what's going on in the market, and this is just a list of 30 companies in the stock market. Then you have the NASDAQ, DAQ, the NASDAQ 100. And what this is this is a list of the 100 biggest companies in the stock market that are not financial. So these are all your big companies that are not your banks, that are not your investment institutions. And so a lot of these companies in the NASDAQ actually end up being tech companies, because the next biggest company besides financial companies are tech companies. So the NASDAQ is another way for you to get an idea of what's going on in the market outside of the financial space. And then you have the S&P 500. This is another very popular one. The S&P 500 is a list of the 500 biggest companies in the stock market that are publicly traded. So this looks at the market capitalization. The market capitalization is how much a company is worth. So this became very popular back when I think it was Amazon or Apple. They became the first $1 trillion company. Now, this doesn't mean that Amazon has $1 trillion in their bank account. It doesn't mean that Apple has $1 trillion in their bank account. That means that the company itself is worth $1 trillion. So if you take all the number of shares out there, multiply that by the price per share, that tells you its market cap. That tells you how much a company is worth. So a company might only be making, let's just say, not only, but let's just say a company's making $1 billion a year. Based off of that $1 billion worth of revenue, cash flow, an investor might value the company at $100 billion or $1 trillion. So what you have to understand when it comes to market cap does not mean how much cash it has or how much its assets itself is worth. It's what the company, the assets plus the goodwill. Goodwill is everything that you cannot truly measure. This is what the brand is worth. When you take the total company, that is the market capitalization. So you have the S&P 500, the biggest 500 companies in the stock market, the NASDAQ, the biggest 100 companies that are not financial, and then the Dow Jones, which are the biggest 30 companies kind of transplanted. They picked the best favorite 30, and that's the Dow Jones. Those are the three different indexes, the three most common indexes in the stock market to give you an idea of what's going on in the stock market. Do you have any questions so far?
Yeah, you mentioned before about blue chip stocks.
Yes.
What are those?
So that's a great question. So you have blue chips, large cap, medium cap, small cap. These are just different ways to categorize a stock or a company. A small cap company is by definition a company that has a market capitalization of less than $2 billion. So it's a company that's worth less than $2 billion. Then a medium cap company is a company that's worth somewhere between $2 billion and $10 billion. And then you have a large cap company, which is a company that's worth more than $10 billion. So small, this is under $2 billion. I will put that like this. Medium, which is 2 to 10 billion. And then you have large, which is 10 billion plus. Then you have blue chip companies. So blue chip companies are your large, well-established companies that everybody knows of. These are companies that have established profits, and these are the big names: Amazon, Coca-Cola, Facebook. These are your blue chip companies. Your blue chip companies are always large caps, but in order to be a blue chip company, you're gonna have to be pretty large. You have to be a household name. So typically your blue chip companies, I mean, technically it can be over 10 billion, but typically your blue chip companies, in order to become a blue chip, it's going to be worth over $100 billion. So great question. So when it comes down to analyzing the stock itself, you have the small, medium, and large cap, and then you also have different types of stocks. You have growth stocks, you have income stocks, then you have value stocks. So your growth stocks are your smaller companies that are trying to grow bigger, faster. So you can think of a growth stock kind of like a startup company. When a startup company makes $1 million, what they want to do with $1 million is not just keep this money in the bank. They want to take this $1 million and reinvest all of it and more back into the company, because a growth company's job is to grow as big as possible, as fast as possible. They're trying to acquire as much market share as they can, even if that means losing money. So an easy example of this is just think of Uber. When Uber was really trying to grow, they were younger, they were going into new markets around the world. And what they were doing was they were losing money on every single ride that they gave. Why? Because they were trying to acquire more market share. They were trying to beat out Lyft and these other competitors, because they're saying, if we can underprice all the other competition, you're not going to go to Lyft. You're not going to go to the local rideshare company. You're going to want to use Uber because it's cheaper. Now, Uber is losing money every single time, but what they're doing is they're building more users, because now the goal is, once they become a dedicated fan and a user of Uber, then they'll be able to raise their price. So anytime Uber made $1, they would reinvest $1.20 back into their company. So they'd go out and raise more money. They'd go out and borrow more money. That way they can grow bigger, faster. So these growth companies don't actually show profits because they're losing money, because they're taking all of their money, reinvesting it, and more because they want to grow bigger, faster. You can compare that to something like a value company. A value company is your more traditional, kind of like your blue chip company. Your value company is something very established, and these companies have your solid profits. They're making a lot of money, and then they have cash in the bank. Now, what these companies are is your more stable investment, and all these companies are trying to do is just keep growing at a steady, stable rate. So your value companies don't always give you the same returns, or they're not going to typically give you the same returns as a blue chip company, but they have less risk. These value companies have more cash in the bank, they're more stable, and so they're not trying to grow much bigger and much faster because they're already so large. When you are a very large established company, it's harder for you to grow faster because you're just not as small and as nimble as a startup. And then you have your income companies. Income companies are companies that pay out dividends. These are companies that you're investing in because now all you want is you want cash flow. So some companies are only going to pay you if you sell your stock. So if you invest in a growth stock, a company is not going to have profits. The only way that you're going to make money is if you can sell your stock for a higher price. And the goal is that you're going to see the price of your stock grow significantly faster because now you're investing in a startup, but it's higher risk. It can go down. With an income company, you're investing into a company that has big profits. And what they're doing with that profit is they're just paying this money out to the shareholders, people like you, in the form of a dividend. So when you go out and you invest in this type of income company, you're trying to get this type of cash flow because now you don't have to sell your stock. They're literally every 3 months, every quarter, maybe every month, depending on the company, they're just sending you a check or they're depositing this money right into your bank account as a dividend. You don't have to do anything to get this cash. You just have to own the right company. Now, you might say, well, that sounds so interesting. Why wouldn't you want a company that pays out a dividend? Well, think of it this way. If a company has $1 billion in their bank account, what are they going to do with the money? There's 3 things that a company can do with this cash in their bank account. They can save this money for an emergency. They can reinvest this money back into the company to grow bigger, or they can give this money to their shareholders, either through the form of a dividend or a stock buyback. A stock buyback means that they're just going to take this cash and buy back their own stock to make their stock price go up. Dividend is when they just give the money away. Well, if they give the money away, it's good for you because now you get this cash in your pocket right now. You don't have to sell your stock. But the downfall is that means they're going to take this $1 billion and not reinvest it back into the company. So they're not trying to grow that much bigger because they've already established themselves. So if your goal is just to generate cash flow, then hey, that's fine. But if you want to see more of the potential upside, then you're not going to necessarily see that if a company is taking billions of dollars every year and they're just giving it away to the shareholders because now they're not taking this money and reinvesting it back into the company. They're just using it to pay off the shareholders. And typically now, when a company is paying out their dividends, that means that they've already established themselves and that means that they're a lot larger. So does that answer your question now for building the foundation? Am I missing anything here?
I don't think so. That was perfect.
All right, let's go to number 2 now. How do you actually make money in the stock market? So I'm going to flip this around because that'll make it a little bit easier, because this is where you have to understand what is your strategy when it comes to investing your money in the stock market. So the first thing you got to understand is the difference between trading and investing. Trading is I'm trying to buy a stock today and make a profit on it in a year or less, and I'm just trying to sell it for a profit. Investing means I'm holding on to my stock for a year or more because I believe in the long-term value of this company. Typically, we're going to be talking about many years, but a minimum of 1 year. Trading is 1 year or less. I'm not a trader. I'm an investor.
Right.
And so I have no intention of buying a company, trying to flip it in 3 months for a short profit. So traders, you have a whole bunch of different types of traders. You have day traders, momentum traders, swing traders. These are people that are trying to find a company that's on the verge of a breakout. They're trying to find a company that they think will pop in the next 2 hours or the next 2 months, and they want to buy it and they want to sell it quickly. This is not what I do, and we're talking about stock market investing in this video, so I'm not going to talk about this. You can make a lot of money trading, but it's high risk. This is active trading. You're actively involved, but it's not for me. I'm an investor. So now when you're investing your money, what you're doing is you're trying to find a company that you believe in, that you want to own for the long term. You want to own a piece of the company because you like the company, you like the financials, you like the fundamentals, and you want to own it. But in order for investing to work, you have to know your strategy. Again, because there's multiple different investing strategies. You have an active strategy, and then you have a passive strategy. So let me start by talking about the passive strategy, because then the active strategy will lead us into number 3. A passive strategy is now you are not super interested in monitoring stocks. You're not super interested in reading the financials. You're not super interested in reading the fundamentals and keeping up with the company and studying everything that a company is doing. You just want to get exposure to the stock market because you hear you can build wealth in the stock market, but you don't know what to do. So you have a lot of people in this passive side where they say, yeah, I want to get exposure to the stock market, but I don't really care about doing all this research. So what do? They just throw their money into the companies that all their friends are buying. They hear the news talking about Tesla, or they hear the news talking about whatever company, and they just throw their money in there because they assume that it must be a good investment. But the problem with that is if you are not going to spend the time researching companies and keeping up with their company, you could end up buying a company that is not good. And now when you put all of your money into a stock or just a few stocks and one of your stock tanks, well, now you're really going to be the one paying the price, because if the stock goes down to 0, you lose everything. So it's much riskier. Now, you can obviously mitigate that risk by doing the research. I'll talk about that in the active side. But if you're not willing to do the research, then another option is just investing in funds. This would be something like an ETF or an index fund, and maybe even a mutual fund. So you probably heard of these different types of terms. People talk about this at offices all the time. If you invest in a 401k, they talk about ETFs, index funds, mutual funds. These are all just different types of funds that give you exposure to a different basket of stocks. So an ETF is an exchange traded fund. You can think of this, you could trade an ETF just like a stock. These are ticker symbols, and you can buy and sell an ETF just like you could a stock. An index fund works similar to an ETF, except you can't always buy and sell an index fund the way you can an ETF. Most index funds require you to buy this index fund only one time a day. You can only buy it at a certain time of a day, and you can only sell it once in a day, so you can't trade an index fund. And a lot of index funds also have a minimum balance requiring you to invest somewhere between $500 to $2,500 typically. Some index funds are going to have higher requirements, some are going to have less, but it's a little bit more difficult to invest in index funds. Then you have mutual funds, which work kind of like index funds in the sense that you can't always buy and sell a mutual fund every single day, all throughout the day. There are usually certain times where you can buy mutual funds. Now, there are some exceptions to that. And many mutual funds have a minimum investment requirement. Now, besides the price and how you invest in them, the second major difference is how these funds work. So all of these funds are a basket of stocks. So we talked about first finding the best company to invest in. But instead of you trying to find the best company to invest in, you can invest in a fund that gives you exposure to a whole bunch of companies. So this fund might have companies like McDonald's and Tesla and Amazon and on and on and on that went out. You don't have to find the best company. You don't have to invest in just McDonald's. You can invest in this fund that gives you exposure to McDonald's and 500 other companies. So now if your company that you invest in goes bankrupt or goes bust, well, you're okay because you have 499 other companies in this fund. That's the advantage of using a fund like this. So now the difference between these three is that an ETF and index fund are passively managed versus a mutual fund is actively managed. So what that means is really comes down to your fee. How much money do you have to pay to invest your money into these funds? So an ETF and an index fund have a computer managing, I'm gonna draw a computer right here. Does that look like a computer?
Perfect.
So you have a computer here managing this fund. And let's assume that this fund gives you exposure to the S&P 500. So it's giving you exposure to the biggest 500 companies on the stock market. Now what this computer does is every day, all day long, it's just checking the algorithm. Are these companies the biggest 500 companies in the stock market? Do they fit into the S&P 500? Well, if one company, let's say McDonald's, has some problems, they start selling bad burgers, and this company is no longer in the S&P 500, well then this computer will kick McDonald's out and it'll bring a new company in. So it's not very expensive because it's the computer managing this whole thing, which is why your fees are significantly less. And it's an easy way for you to get exposure to the general stock market. You can get exposure to the S&P 500 by just investing into an ETF or an index fund that gives you exposure to that. A mutual fund, on the other hand, doesn't have a computer doing this. You have a very expensive money manager with a mustache. So you got this money manager here, and this money manager probably went to Harvard or Yale or Princeton, one of those big Ivy League schools, studied how to manage stocks, how to find good companies. And now this person's job is to find the best companies for you to invest in. Now, the goal here is that this money manager is trying to beat the average returns of the market. That's why you're paying this person higher fees. But if you look at the data, what you'll see is that most money managers cannot beat the returns of the market over the long term. Maybe they can for a year or 2 or 3 years. But if you look at it for the long term, for a period of 10 years or 20 years or 30 years, they cannot outperform the market year after year after year. And then when you add in their fees on top of that, many times it is more beneficial for you to just invest your money into an index fund or an ETF. This is why Warren Buffett says that for the average person, they should not be investing in mutual funds. They will save money and get better returns if they just throw their money into an index fund, a low-cost index fund, because you can save money on the fees and just get the general returns of the market. Now, in some instances, it will be beneficial for you to invest in a mutual fund, but many times those are a little bit more sophisticated, and you might need a little bit more dollars to get access to that mutual fund, because now you're getting access to the better and more qualified money managers. But there are times and places where mutual funds can be beneficial. But an index fund and an ETF work the same way in that they are passive. An ETF just works kind of like a stock. You can buy and sell an ETF anytime you want. They have your regular ticker symbols. Index funds are a little bit more difficult, where you can't buy and sell index funds throughout the day. And many times you might have to buy the index fund directly through the corporation itself, the investment institution itself. So one of the most well-known and most credible index fund sources is Vanguard. Vanguard was the original creator of the index fund. And if you want to buy a Vanguard index fund, some brokerages will sell it, but you can go directly onto the Vanguard website and buy index funds there. Any questions on the passive side?
No.
So this is your passive way of investing your money. The way that you do this now, the right way, is you're just going to set up a schedule. Every week or every 2 weeks or every month, you're going to have some money that leaves your account and goes directly into your fund. So you're going to do this whether the market is up or down, and you're just going to keep doing this week after week, month after month, year after year. It's going to be on autopilot, and it's going to be passive. That is the way to make this passive strategy work, is you just keep doing it again and again and again, and you're just accumulating shares of this fund, and you're letting the market do its thing. That is the way that you win with this passive strategy. And the key is you continue to do this when the market is up or down. So you're just going to keep following this passive strategy. The active strategy is a little bit different. What you're doing here is you're trying to find actual stocks and companies that you want to invest in. So again, maybe you're the type of person that says, yeah, this is cool, but I really want to be a little bit more involved. I like the idea of researching companies. I like the idea of studying companies. I like reading the financials. And I want to know, how do I actually invest in companies? This is what Warren Buffett does. He is an active investor. He's not a trader. He's an active investor. So he's spending his time reading financials. He's spending his time trying to analyze companies. He wants to know which company he believes is undervalued. Then he's going to buy it, and he's going to hold on to it for a long time. Now again, when you're actively investing in companies, there's two ways that you can get paid. You can get paid if you see, drop my marker over there. You can get paid if you see appreciation, or you can get paid through a dividend. I'm spelling these words wrong. A dividend, like we just said, is when they pay you with cash flow for investing in a company. They're getting the profits, and now they're paying you. Appreciation is when the stock price goes up. So you bought a stock for $100 a share, now it goes up to $200 a share, and you sell it. That's appreciation. Sometimes, if you invest into a company early enough, you might be able to invest into a company for $100 a share. They're not paying any dividends. Then it goes up to $200 a share. Now this company becomes much more established. And then they start paying you a dividend as well, because you bought into the company when it was a growth company. Now they've become more of a value company. It's worth a whole lot more. And because you bought this company when it was young, now they're also paying you dividends, so you get to win both ways. That's why the key to really win in this active side is you want to be investing for the long term, and you want to be investing in companies that you believe are undervalued. Hold on to them, and you want to make sure you do your research on the analytical side, that way you understand the company that you're investing in. Now, before I get into the analytics, anything else that you want me to go over regarding this active side of investing your money, that way you understand how do you actually make money in the market?
Yeah, I've been hearing a lot about this timing the market. What exactly does that mean?
We're going to jump back to the video in just a second, but before we do, if you are interested in learning more about how to manage your money and invest your money the right way to build wealth, our team put together an amazing guide on money management and investing that you can read for free, that will walk you through the different things that you need to know about financial education and money management and investing. These are all things that we should have learned back when we were in school, but this is what this guide is supposed to do, to help teach you the things that we should have learned when we were growing up. Our free guide will walk you through how you can start managing your money, how you can create a system for your money, and how you can start investing your money for wealth. This is what wealthy people are doing with their money. So if you're interested in learning more about how to manage your money and invest your money for wealth, you can read our guide for free when you sign up for our daily newsletter, and I'll put the link to how you can download this guide in the description below. Now let's jump back to the video. Perfect. So when you talk about investing your money, one thing that people try to do is they look for I think that we are going to see a market crash, so I'm not going to buy now. Or I think that the stock market is super high, so I'm not going to buy now. Or they say, I think the stock market is low and I'm just going to buy now without doing any of the research. So Warren Buffett says it the best. He says that time in the market beats timing the market. So what that means is when it comes to, especially here, when it comes to trying to invest your money in your market, you don't want to try to predict when a crash is going to happen or try to wait for a crash because you never know when it's going to happen. Nobody can predict when the next market crash is going to happen, when the market is going to correct. But what you can do is make smart, fundamental decisions. We'll talk about that in just a second, but that means you need to know how to research companies, know how to analyze companies, and based off of that, you should make smart financial decisions based off of what's going on today instead of trying to predict what's going to happen next week, next month, or next year, because no one's going to predict. No one can predict that. You don't know what's going to happen in the world. You don't know if a new virus is going to come out of nowhere, shut down the economy. You don't know if a new regulation is going to be passed by Congress, which can hurt companies. You can't predict that. But what you can do is analyze the numbers and invest your money here on the active side based off of what the numbers show. And even on the passive side, this is why I kept saying that you don't want to stop this strategy if the market goes up or down. You want to keep doing this whether the market is up or down. This needs to go on autopilot. And you don't have to pick one or the other. I have both this strategy and this strategy when it comes to investing my money in the market.
Gotcha.
Every week, I have money that is automatically leaving my bank account and being invested into a number of different ETFs. They give me exposure to different sectors in the market. Some that give me exposure to the general stock market, some that give me exposure to more specific sectors. So I have this going on every week, and then I have cash here that I'm waiting to invest. So I'm looking at companies, I'm researching companies, but I'm just looking for the right price. I don't want to overpay. This is where my analytics come into play. I'm looking at companies and I'm trying to see what is a good price for me to buy. When I see a company go down to a price that I think is fair or that I think is undervalued, then I'm going to come in and pull the trigger and buy. So I'm not trying to sit here and time the market. I'm looking for the right companies, the right investment. And then if the market does come down, that is Black Friday for investors. That's when I should be coming in, or you, in the case of an investor, that's when you should be coming in and buying more aggressively. When stocks go down, investments go down, that's when you should be coming in, buying more aggressively because market crashes and recessions make more millionaires than any other time. Because what happens? Your average investor, your traditional investor gets scared and they run away. But that's the time when you should be getting greedy. That's the time when you should be buying. This is what I know I'm quoting Warren Buffett like everywhere here. But what he says is when people are panicking, get greedy. When people are greedy, that's when you should be panicking. That's when you should be kind of fearful. Be fearful when others are greedy. Be greedy when others are fearful. So when people are scared, when people are selling, that's when you want to be doing your research, buying the right companies and buying it as aggressively as possible because you're buying it at a discounted price. But when people think that the market cannot go down, that the market can only go up, that's where you want to be a little bit fearful and be more diligent in your analysis. Does that make sense? Does that answer your question on that?
Yeah, that's perfect.
All right, sweet. So now let's go on to number 3, where we talked about now actually analyzing companies. So I'm going to draw this line over here. So when it comes down to analyzing companies on the fundamental side, this would be right here. So we kind of like, you take the stock market and at a whole, you got trading and investing. Then with investing, you can divide that in half. You got the passive investing, you get the active investing. So now focusing just here on the active investing side, if you want to analyze companies, you got to look at them fundamentally. That means you want to look at how are their revenues doing, how are their profits doing, what are their expenses, are these expenses growing, what are their cash flow statements telling you, what is the PE ratio. These are all different ways to analyze a company. So let me start with just the PE ratio because this is probably one of the most easily understood and one of the most commonly talked about ratios. So this is your price to earnings ratio. So going back to the guacamole example that I gave you, let's assume now that my guacamole company made $1 million in revenue, and I'm gonna revenue, and out of that I had $800,000 of expenses. So although I made $1 million, I only walked away with $200,000 profit. Now, this $200,000 is sitting in my bank account. This is the profit. And now I have to value my company. Now, some investors are going to say, well, I think your company is worth 10 times earnings. Some people might say, I think your company is worth 20 times earnings. This is what my company is actually worth. So if my company is worth 10 times earnings, that means I take my earnings, $200,000, multiply it by 10, and that means my company is worth $2 million valuation. In this case, it's called your market cap. Your market cap is your valuation. This 10x, this is my PE ratio. In this case, my PE ratio would be 10, because that means I'm taking my earnings, my $200,000 of profit, multiplying it by 10, that comes with this up with $2 million valuation. So this is a very commonly used metric just to kind of get a rough benchmark baseline of what a company is worth. So if you go onto any stock research website, they're always going to say what the company's PE ratio is. You're going to see some companies with a PE ratio of 10, some of them are going to be 100, some of them are going to be 1,000. So to put that in perspective, here my PE ratio is 10, is valued at $2 million. If my PE ratio was 100, that means my company would be worth $20 million. If my PE ratio was 1,000, that means my company would be worth $200 million based off of my $200,000 worth of profit. Now, at first glance, you're going to say, what the heck? Any company with a PE ratio of 100 or 1,000 is automatically overvalued. Yeah, you might be right, but it also depends on the market, and it also depends on the industry, because certain industries are going to have different normal PE ratios. So certain industries, like the tech industry, typically have higher PE ratios. Other industries, like retail companies, typically have lower PE ratios. So when it comes down to comparing PE ratios to see what company is overvalued or undervalued, you want to make sure you're comparing apples to apples. You don't want to be comparing a tech company's PE ratio to a retail company's PE ratio. So you don't want to compare Tesla's PE ratio to, let's say, Walmart's PE ratio. You want to make sure you're comparing apples to apples. So you want to make sure, for one, that you're comparing companies within the same industry, and then second, your market is going to play a contributing factor to how high or low PE ratios are. If interest rates are low, you're in a higher inflationary environment, then you're going to see more people, more institutions pour their money into the market, and that could drive PE ratios up just because people would rather own stocks, which are also known as equities, rather than just keeping their money in cash. So you have to make sure that you're looking at the industry and also the market. Now, the second thing that you want to look at when you are analyzing stocks is you have to research something called the 10, I'll put that as a Q, the 10Q and the 10K. Your 10Q is your quarterly summary that a company releases, and a 10K is your annual report that a company releases. So a 10Q is released every 3 months, every quarter. These are unaudited financial statements versus the 10K are audited financial statements. So that means that every 3 months, a company has to go out and do an earnings call. So that means your executives of the company are going to go onto a call with their investors. They're going to go onto a call with anybody who wants to be on. Like, you can listen on to an earnings call. You go onto the call, and they're going to say, last quarter, we did X number of sales, we did this revenue, we had these expenses, and we predict the next quarter we're going to see more growth, less growth, and we predict the next year we're going to have these issues. So this is what the company is doing every 3 months to give the investors kind of an insight of what's going on in the company. Every 3 months they're required to do that. But you also have to remember that these are unaudited, meaning that they're just giving what they think is going on. They don't have an external agency reviewing their statements, so you can have some things that are wrong in these 10Qs. So you got to keep that, with a grain of salt. Your 10K are your annual statements. So once a year, a company has to do a more in-depth analysis where they're going to have to go over all the financials, how everything went for the last year, how their revenues were, their profits, what their cash balance is looking like, how much money they have in the bank, how much debt do they have, what were their investments, what were their expenses, and what they plan to do in the future. So these are audited statements, meaning you have an external company that is reviewing this, so you have an idea that this is a little bit more accurate than this. So this information can be analyzed. You can find this information on, again, pretty much any stock analysis website, or you can go onto seekingalpha.com. That's the site that I like to use. where they have this information. You just go on to Seeking Alpha, you go to the stock company, the ticker symbol that you want to research, and then you look at the 10Q and the 10K, and everything is going to be laid out right there. And on that, you're going to be able to see things like their revenue, their expenses, and their profit. That's where I like to start. I want to take a look at the revenue and see what's been going on with the revenue over the last 3 years. That will give you a good baseline of whether revenues have been growing, staying the same, or decreasing. If I'm looking to invest in a company, especially if it's a growth company, I don't like to see revenues going down.
Right.
Especially if it's a younger company. I want to see revenues growing pretty significantly. And the growth of this revenue is again going to depend on what type of company you're investing in. If I'm looking at a growth company, a smaller company, I want to see revenues growing by at least 20% a year. Year over year, 20% top line growth. If it's a bigger company, you're more value, blue chip type of company, you might not see that type of fast growth, but you still want to see growth. So the first thing I look at is revenue. Second thing is expenses. Now, a lot of people assume that if expenses are going up, that's bad for a company because their expenses are going up. But you have to dig a little bit deeper. I always like to ask the question of why expenses are going up. If expenses are going up just because it's more expensive to produce the products, then that's one thing. And that could be a concern, assuming that they cannot raise the price of the products. Because if this is something that people need, like if, for example, it's toilet paper and the cost to produce toilet paper is going up, well, that's bad. But people are going to need toilet paper. So even if the expenses are going up, they should be able to raise the price of the products because most people are still going to need toilet paper. But if it's something that's discretionary, say it's luxury clothing, or let's assume not luxury clothing because you can have a lot more variables in there. If the cost to produce a particular type of luxury clothing are going up and people don't need it, well, if people try to raise the price of that, then they might just say, oh, I don't want this type of shirt anymore. I want that type of shirt because it's just too expensive. That's more bad news. But I also want to see if the expenses are going up because they're investing back into the company. If a company is raising their expenses because they want to invest in a company, they want to grow their users, they want to grow their customers, they're investing in infrastructure, they're opening in new facilities, they're opening new plants, that's good news for me. So I like to see that type of growing expenses. So that's where you have to pay attention to, okay, are the expenses rising? Yes or no? And if yes, why are they rising? Then you want to take a look at the profit. So we talked about here, the profit of a company. There's a lot of different ways to analyze profit. You have things like the EBITDA, the earnings before interest, taxes, deductions, amortization. So you want to look at the profit, and it will break it down for you. There's a lot of different metrics for profit, but you want to take a look at the profit that you come up with, and then you want to compare that to the market capitalization. Remember, the market capitalization is the worth of the company. In this case, it was a $2 million valuation for a $200,000 annual profit. So you want to compare the profit to the valuation and see if it's worthwhile. What you might also see is that a company doesn't have a PE. If this PE ratio is something like this, it says NA, what that means is the company's not profitable. And so that's typically going to be your growth companies because remember, your growth companies are taking all their money, reinvesting it back into the company. So they don't have a PE ratio because they don't have a profit. So if you're price to earnings and you have zero earnings, you can't have, it's a fraction with a zero on the bottom. It doesn't work. So you have to have a profit. So you have to have some sort of earnings to create this ratio. So that's what you want to take a look at. Then you want to take a look at things like the cash flow statement. So this gets really more into the nitty-gritty of a company, and you'll be able to see that all here in the reports. Your cash flow statement is going to show you where the cash is moving in a company. Cash is the lifeblood of the company. The cash flow shows you how the money, the blood is flowing in the company. So you want to understand, okay, does this company have cash in the bank? Now, this could be a good thing or a bad thing, depending on what your goal with the company is. If you want to see the fastest growth, you want to see the biggest potential upside, and the company has $1 billion of cash sitting in the bank that they don't know what to do with it, well, that's not good news because now this is cash that's sitting there not doing anything. Your cash in the bank is not getting you a return. But if they took that $1 billion and they invested it into the company, or they used this $1 billion to buy up new companies, well, now they're getting a return on the cash, and that could really drive up the valuation of the company. So you have to look at now, what are they doing with their cash and what are their goals? Because some companies will say, we don't have a better use for our cash. we want to keep this money in cash reserves. Well, if you're trying to see high growth, that's not good news because your cash is just sitting there doing nothing. So these are the type of questions that you want to be asking. And so that's why you want to take a look at the cash flow statements, the profit and loss statements, and all of this information is public when you go to these stock analysis websites. Seeking Alpha has a ton of resources there. You can start there, go to Yahoo Finance. There's a ton of different information there. Any other information, questions on this type of analysis? Anything you'd like me to go over on that?
So you mentioned expenses. Where does debt kind of play into all of this?
Great question. So if you go into these reports, you're going to see how much debt and what liabilities a company has on their books. And this is something that you want to pay attention to because debt can be useful, but it can also overburden a company. And so when you are in a low interest rate environment and you want to see growth, typically you want to see a company now taking on a whole bunch of debt. Because if a company can grow their revenues or their profit by 20% a year, and they can borrow money at 5% a year, there's a huge spread there. They're borrowing at 5 and they're getting a 20% return. So that means there's a lot of room for profit. But there can be an issue when debt becomes an overburden, when they have way more liabilities than they have assets. So again, you go to these statements, you're going to see their assets, you're going to see their liabilities. If you see their liabilities significantly higher than their assets, they owe way more money than what they're worth, than what their assets are worth, then that could be a concern. And you want to ask the question of why. If they're heavily investing in growth, then okay, again, risky. But if they're not heavily investing in growth and they just have all this debt that they're working to pay off, then what does that mean? That means that now this company, anytime they make money, they can't invest it in growth because they need to take this cash and use it to pay down their previous debt. This is one of the reasons that so many companies go bankrupt is because they start leveraging up debt because their company starts slowing down. So what do? They start borrowing money. That way they can try to grow faster. And they keep trying to spin the wheel by just borrowing money to keep running the operations. But if the company does not continue to grow or it continues to slow, now they have this mounting pile of debt while their assets and their income is not growing. And then this can force a company into bankruptcy because now there's bankruptcies where they now declare bankrupt on this debt because that's the only way that they can get rid of this debt. They will not be able to pay it off through their company's operations and they have too much debt. So you always want to also take a look at their debt position and what has been going on with the debt position, because if the debt position has been growing without the growth in the assets, without the growth in the income, then that's a red flag. And that also goes into understanding a company. So actually, great question, because now I want to talk about the moat and the actual fundamentals of a company. So a company, a moat, this term is also coined by Warren Buffett, but a moat, think about it like a castle. And we're going to war.
Right.
If I have a castle and I'm in this castle and a company, or sorry, another civilization is trying to attack me, and I have a very small moat, small little river that's very easy to cross, well, it's going to be very easy for the enemy to get to my castle and take over if our forces are not strong. But if I have a strong moat, a big moat, and I got alligators in there, and I got all these animals in there, and it's very difficult for you to cross that bridge, well, now the enemy is not going to be able to attack me. I'm going to have a strong fortress, and I'll be able to run my civilization, my company in this case, very strong for a long time. So a moat is, how hard is it for another company to come in and take my company's spot? How hard is it for another company to beat me at my own game? So a company with a strong moat, for example, would be Coca-Cola. Coca-Cola has a very strong moat because people love Coca-Cola and they will be willing to pay significantly more for Coca-Cola than their competitor like RC Cola. If you take RC Cola and Coca-Cola, put it on the same shelf, you charge $2 for Coke, 25 cents for RC Cola, people will still buy the Coca-Cola because people love the Coca-Cola. They love the brand. And so that's where you have a strong moat. And then on top of that, Coca-Cola also has strong contracts with movie theaters, restaurants, drive-through places. I mean, they have contracts with so many different industries where now, if you wanted to take Coca-Cola's spot, you have to now go and not only build that brand trust, but you have to go and make these companies, these restaurants and all these other companies, cancel their contracts with Coca-Cola, which is expensive, and then take your contract. That's not easy to do. So Coca-Cola has a strong moat and a very heavy moat because of that, versus something like Abercrombie and Fitch. You're more trendy retailers. The trendy retailers don't have a very big moat because people's interest in clothing change very quickly. And what might be popular today might not be popular next year or the year after that. And those also have very high expenses. They don't have particular contracts that are hard to break. So they have a low moat. It's easier for a competitor to take their spot. So when you're investing in a company, you also want to think about how hard is it for a competitor to now come in and take my company's spot? How big is the moat? And that goes into now, what are the products that your company is producing? Is this a product that is going to be beneficial and necessary a year from now, 5 years from now, 10 years from now? Or is it something that is in the dying phases? Take a look at Sears, for example. Sears used to be the powerhouse retailer. Nobody used to think that Sears could ever go bankrupt because they were the monster. They were the Amazon of their time.
Right.
Well, when Sears started to go down, you had a lot of people that said, Sears can never go bankrupt. Like it's Sears. Come on. Like Sears is not going to lose their position. Sure, maybe they're not number one. They might be number 2 or number 3, but they'll always be around. So people would buy Sears, the Sears stock, on its way down. But what they didn't realize was that Sears was not innovating for the future. The world was moving digital. Sears was not. Sears kept investing into their own physical brick and mortar presence. They kept trying to do a lot of things to make people want to come into the store instead of trying to invest onto their digital presence. And so people kept buying it. But what they weren't looking at was the 5-year plan or the 10-year plan. And Sears was not able to survive that. And so because of that, their product was not inventing for the future. They were not investing for the future. They were just looking at now, and they were looking at the previous business models. So you want to look at, okay, what is the moat, but then what is the product? Is this company innovating for the future, or are they innovating for the past? Right. And that can be hard because companies assume that, hey, we're the top dog. How is somebody else going to take our spot? How is some little e-commerce company like Amazon going to take us out of business? Well, this is where you have to be understanding what is the company doing to try to innovate, and you're going to say, how do I understand if a company is innovating or not? Listen to their earnings calls. You're going to listen to their executives, and you're going to hear very easily if this company is innovating or if this company is old school and they don't understand where the world is moving. So those are the type of questions and the things that you need to pay attention to. Does that answer your questions here on the how to analyze the company side, or am I missing something?
One more for you.
All right.
I'm wondering too how the stock market kind of booms and busts play a role into when or how I should invest in a company. Does it play a good factor?
Sure. So every market, you either have bull markets, bear markets, or sideways markets. These things happen. Booms and busts are part of the economy. They're part of the stock market. They have happened for centuries, and they will continue to happen. A bull market is when the market is going up. A bear market is when the market is going down. And then you have a sideways market. Sideways market is where things are kind of just going like this. You don't really have much. So bull market up, bear market down, sideways market, things are just moving sideways. You're not saying up or down. Mm-hmm. So booms and busts are part of the economy. This has happened in the past. It will continue to happen. Now, in the stock market, obviously, the saying buy low, sell high, it makes sense. I mean, if you see prices go down, if you see a market crash happening, this is a much better time for you to come in and buy. I mean, if you look at previous market crashes, like the 2020 stock market crash, the 2008 stock market crash, the 2001 stock market crash, if you came in and bought a company that was valuable, that had real products that people wanted, well, you could pretty much buy anything and you were going to make a lot of money because everything was on sale. So when you see those type of market crashes, it's a great opportunity to buy. You should always be buying when things are going down. In that sense, assuming that you're buying something strong. If you're buying something on the verge of bankruptcy, well, then that's an issue because then you're just trying to catch a falling knife and then the knife goes down to zero. So, when you talk about analyzing companies, this analysis is what you want to be doing regardless of where you are in the economic cycle, regardless of where you are in the market cycle. But this market cycle will play an effect on the valuation of companies. Because when markets are down, the prices of companies are going down. So that means this top number in this fraction is going down, which means naturally your valuations of companies are going to be dropping because the prices of companies are dropping. So you could come in and buy a company that normally trades for a 100 PE ratio for maybe a 10 PE ratio. So you have the opportunity to come and buy more aggressively. This is why when you're doing this type of analysis, you want to remember, you're trying to analyze companies based off of not just the industry, but also the market. So in certain markets, you're going to see certain higher PE ratios, but you might say, well, why don't I just wait for things to drop? That way I can come in and buy. Fine, but you don't know how long you're going to be waiting. Right? There's no way to predict what's going to happen tomorrow, next week, next month, or next year. So instead of trying to do that, you want to make sure that you're finding companies that you believe in for the long term, and make sure you don't overpay today. That way, even if things go down, hey, you know that you paid a good price for it and you bought something that has real value. And if it goes down, well, then you can just buy more aggressively. That's when you come in and buy. Answer your question, Nate?
Nailed it.
All right, cool. Let me pull up my chart again to talk about number 4. Number 4 now is how do you actually buy a stock? Well, back in the day, this used to be very difficult because you had to actually call up a broker. You've all seen like the Wall Street movies, the original Wall Street movies, not the newer Wolf of Wall Street, like the original Wall Street. I think it was called Money Never Sleeps. You'll see people, how it used to work, where you used to have to call into the brokerage, and that was actually calling into a stockbroker. But you used to call into a brokerage and you'd have to call someone and say, hey, I want to buy shares of Ford or McDonald's or whatever company that you want to buy. So investing in the stock market used to be really reserved for the people that were wealthier, richer, had access to this type of information. Over the years, this has really changed. First, you started to see digital brokerages, things like E-Trade and Charles Schwab and TD Ameritrade came out. And then the most recent kind of change was your zero commission brokerages, because back then, if you wanted to go out and buy shares of a company, you'd have to either pay a percentage or you'd have to pay a flat fee. First, it was like $12, then $10, then $7 to make one trade. So whether you wanted to buy one share or 1,000 shares of a company, you'd be paying $7 to $12 to make that trade. And then when you wanted to sell, you'd have to pay that commission again. Then came the growth of things like Robinhood, who's also a sponsor from Minority Mindset. But Robinhood was one of the first companies to really change that, because Robinhood allowed you now to invest in companies without paying any sort of commission. And the way that Robinhood makes money is they sell margin debt. So if you borrow money from Robinhood, then that's how they make money. And then second is when you place your orders, they sell that to a third party. And then the third party is the company that's helping to monetize that. They are paying Robinhood. So nowadays, pretty much most established brokerages are going to charge you $0 in commissions to trade, but you need to use a brokerage. And this is so easy and so accessible now, because now you can start trading stocks with literally as little as $5, $10. And you can even invest in fractional shares of a company. So even if you want to invest in, let's say, Amazon, which is a very expensive company to buy, you don't need the full price to go out and buy one share of Amazon. You can just buy a fraction of one share thanks to these companies. So the first thing you want to do is you want to know of a good brokerage. I'm going to go over a couple. Some of them are sponsors of the Minority Mindset, but feel free to do your own research. I'll talk about what I use, and then you can decide what's right for you. So on the passive side, let me go back here. I use a company called M1 Finance, who's a sponsor from Minority Mindset. The reason why I like M1 Finance is because what you can do is you build something called a pie. And a pie is literally just, I can designate what type of stocks or ETFs that I want to have. So I build this pie, and then I can say, all right, I want to invest in this ETF, this stock, this ETF, this ETF, and stock. And you can pick your percentages or whatever, and then you can set your schedule. So for me, it's every week. Every week, money leaves my account, goes into this pie, and it's automatically distributed based off of the percentages that I allocated. So it's super simple, it's on autopilot, super easy to use, and it's automatic, and it happens by itself. And that's why I love it. And it doesn't cost you anything to do it. So this is why I like M1 Finance. There's other accounts that let you do this, but if you want to learn more about our sponsor, M1 Finance, I'll also link that for you in the description. Then on the active side, if you want to actively buy companies, the most popular one for young people is Robinhood. They're also a sponsor for Minority Mindset. They were one of the first to allow you to actively buy and sell stocks, and now also let you buy and sell cryptos. They don't charge you a commission to do that. They're very user-friendly. They've had their issues in the past, but they're trying to work on them. So Robinhood is the most popular one. If you want to learn more about Robinhood and see how you can open a free account, I'll also link that for you in the description. And then you have the more traditional stock brokerages, things like E-Trade, TD Ameritrade, Charles Schwab. I have accounts with multiple. I have accounts with E-Trade, TD Ameritrade. So, I mean, you can find what's right for you. They all pretty much do the same thing now. Just make sure you're doing a reputable company. Everything that I've said so far is reputable. They've been around for a while. They've proven their success. And obviously Robinhood has had their issues, but for young people, I mean, that is like the go-to. They have a lot of cool things for young people, but just make sure that it's reputable, that they've been around for a long time. So you just open up a free account with any of these companies, and then you can go out and start buying and selling stocks. The next thing I want to go over, this is why I wrote this down, that way I don't forget what I want to talk about, are actually placing the orders. So when you go on to any brokerage and you want to go out and buy a company, they're going to ask you what type of order do you want to make. Do you want to make a market order or a limit order or something else? I want to focus on market orders and limit orders because those are probably the two most important. A market order means I want to go out and buy 1 share of Tesla, and I'm willing to buy it at the market, meaning whatever the price is right now. So if I go out and I place a market order of Tesla, and this is when the stock market is open, and I say I want to buy 1 share, it's going to buy the share right now at whatever the price is. So that's what a market order is. A limit order is I want to buy 1 share of Tesla, but I want to only execute on this purchase at a particular price. So let's assume that my price is $400, okay?
Wow.
Yeah, I want to buy 1 share of Tesla, but I only want to buy it at $400. If it does not hit $400, I don't want to buy it. So now I can place a limit order for $400 for Tesla, and then I can also write this order will expire at the end of the day today, or it will expire at the end of 60 days, or some brokerages will say no expiration. So if in 6 months, Tesla's price goes down to $400, then it will execute the order. But if it never hits $400, I will not buy. So the difference in a market order and a limit order is a market order means that you're buying it right now, whatever the price is to execute. A limit order is you pick the price. If it doesn't hit the price that you pick, it will not execute that order. But if it does hit that price, then it will execute that order. So limit orders are if you want to be a little bit more hands-off. The risk with limit orders is, let's say I want to buy Tesla at $400, but then it starts dropping and it just goes down to $250. Well, it's going to execute my order at $400. And if I was watching it, I might say, hey, let me watch it for a couple more hours or for the end till the end of the day or whatever, just to see what's going on with the stock. But the limit order is going to automatically execute it even if it's still going down. So if you just want to buy it at $400 and you don't care about anything else, you use a limit order. But if you want to just buy it at the market, then you use a market order. You also have something called short selling. That gets a little bit more technical and a lot more risky. Short selling is now, instead of me buying a stock to make money when the stock goes up, I make money when the stock goes down. So, for example, let's say a stock goes from $100 a share to $30 a share. What happens is, typically, when you buy a stock, I bought it for $100, I sold it for $30, meaning I lost $70 per share. But if I short it, then what it means is instead of me buying it for $100, the first thing I do is I actually sell the shares. I borrow the shares and I sell them, and then if it goes down to $30, that's when I come in and buy. So you have a lot more risk here because there's no limit to how much you can lose. The stock can go up to $10,000, and now you just lost a whole lot of money because now you're buying at $10,000 and you're selling it at $100. So if you're a newer investor, I don't recommend you do short selling. It's a lot riskier. I don't do short selling. I haven't done short selling. It's much riskier. There's no limit to how much you can lose. Versus when you buy a stock, just to invest in it, the most you can lose is how much you invest. So just one thing to keep in mind. But the general gist of what you want to understand is shorts make money when stocks go down, but buyers make money when stocks go up. Then the next thing you got to understand is taxes. So the nice thing about being a long-term investor is the tax code, the IRS tax code, benefits you, rewards you for being a long-term investor. you get tax breaks, lower tax rates when you invest your money for the long term, because you get something called long-term capital gains rates. So when you invest your money and you make a profit, it's called capital gains. But if you made that profit in 3 months, you have something called short-term capital gains. Long-term capital gains are anything that you made your profit on if you hold on to it for longer than a year. So short-term capital gains at the time of us recording this video are taxed at your ordinary income rates, meaning it's taxed at whatever the income is that you would have paid if you got the money from your job. It's taxed at your regular income tax rates. That's what short-term capital gains are. Long-term capital gains means that now you get a lower investment tax rate. And these are significantly less than your income rates. This is why, they always say wealthy people don't pay taxes. The reason why is because they pay long-term capital gains rates when they sell their investments. And so if they sell their investments for a profit, well, they're going to still pay significantly less money. So even if you're making millions of dollars, your tax rate is way less than if you would have made that millions of dollars from your job, because it's investment tax rates. So if you sell your stocks for a profit after owning it for 1 year, you get long-term capital gains rates. And I also want to mention taxes for dividends, because let's assume that now a company is paying you a dividend and you're reinvesting this dividend back into the company. Every time you get the dividend, that's how you compound and grow your money. You're growing your wealth because you're getting paid and then just using your dividends to buy more shares of the company. Well, that's good, because now you're accumulating more shares of the company, you're building wealth in the company. But the downfall with that is you still earn that dividend and you have to pay taxes on the dividend today, even though it's not in your bank account. That dividend was used to go out and buy more shares of the company, but you still have to remember that you have to pay taxes on the dividend. So you want to make sure you have some cash put aside to pay for your taxes on that dividend. Any questions now on here on how to buy stocks on that area?
Nope, I think I'm all
pretty
set
clear?
up.
All right, I did pretty good on that one. The last thing that I want to go over are some of the mistakes that you do not want to make when it comes down for you investing your money, because when I first started investing my money, I got lucky, because I started investing during the 2008 stock market crash, and we're from Michigan. During that time, Ford, GM, and Chrysler were the biggest employers in Michigan. And GM went bankrupt, Chrysler went bankrupt, and Ford was on the verge of bankruptcy. Now, I was in high school. My dad said I couldn't have a Ford Mustang because it was expensive and whatever, but I really liked Ford Mustangs. So I was like, what's the next best thing that I can do? Let me go out and buy the Ford stock. So I took a little bit of money and I bought the Ford stock when it was super low. I had no idea what I was doing. Ford thankfully did not go bankrupt, and I started making a lot of money on the stock. The stock doubled, tripled. It started going up very fast. Now, I didn't invest a ton of money into it because I didn't have a ton of money, but I think it was a few $100, maybe $1,000, something like that. I don't know. I put a little bit of money in there, started seeing some returns. I was like, wow, I am a financial genius. I know what I'm doing. So then I was like, okay, well, I'm going to start trading. So I started trading penny stocks. I started doing all this other stuff, trying to amplify my returns. I spent the whole summer. I was like, I'm not going to get a job. I'm just going to trade stocks. And the whole summer, I don't think I made any money. I had some winning days, I had some losing days. I probably came close to even, but if I'm being completely correct, I'm pretty sure I lost a little bit of money. But luckily I didn't lose too much money, but it was pretty even. But that's when I started realizing that, wow, I spent months doing this and I didn't make any money. So that's when I started realizing that, okay, I need to start learning. Learning is the most important thing when it comes down to mitigating your risk. And the thing that holds so many people back from investing their money in the market is, what happens if I lose money? Right. I worked so hard for this $10,000, this $1,000, this $100. I understand that if I just keep this money in the bank, I'm losing to inflation, but at least I know that $100 is going to be there tomorrow. I put this money in the market, well, I could see it lose half of its value in a day if I invest in the wrong thing. And you're right, that risk is there. But the best advice that I can give is, there's a risk for investing, and there's also a risk for not investing. If you don't invest, well, yeah, your $100 is going to sit in the bank, your $1,000 is going to sit in the bank, your $10,000 is going to sit in the bank, but it's guaranteed to be eaten away by inflation. So it's a guaranteed loss. Now, if you invest your money in the market, there's a risk that you will lose your money, but there's also a chance that you will grow your money. So which risk do you want to take? The next thing is, if you accept the idea that you will lose money, it'll be much easier for you to go on and invest your money in the market because every single person loses money at some point or another. So what you want to do is go in there with the mindset of knowing, hey, I'm going to lose this money. I have $1,000. This money is gone. Now you're going to be much more likely to take this money, put it in the market. And if you just think this money's gone, well, now if you make a profit, hey, you made some money.
Right.
And if you lose some money, you're not going to be as upset. But at least it'll get you started because you have to get started in order for you to learn. You can watch all the classes, attend whatever you want, buy courses, read the books, but until you start doing it, you're not going to really learn it because you have to experience it yourself. Experience is the best teacher. And so you have to go out and do it. And once you start losing money, you're going to be like, oh, what happened wrong here? What could I do differently? But you have to just start. The key is to start. And the losses that you go through, that's your tuition. That's how you learn. And that will set you up for the much bigger trades, the much bigger investments in the future that can make you more money. And then the next key is really to understand the value of investing for the long term. Understanding that, hey, the people that make the most money in the market are not the people that are trying to just find a quick flip or trying to make a quick buck. It's the people who take away the emotion, and it's the people who are investing on financials. They understand the fundamentals. They understand why they like a company, and they want to invest in that company because they believe in the company, they like the company, they understand the fundamentals, and they think that this company is investing for the future. So now you invest in it and buy. And this can be hard because sometimes you might see the company that you invest in go down, down, down before it starts to go back up. When the 2001 dot-com crash happened, Amazon lost 90% of its value. And that's hard to picture because if you invest $1,000 into it, you see $1,000 go to 900, and 800, and 700, then 300, then 200, then 100. Very few people are not going to pull the plug at that point. When you see your investment going down, you're like, all right, I'm just going to cut my losses. And sometimes you have to. Sometimes you do have to cut your losses. I mean, if I saw my investment go down by 90%, it would probably be very difficult for me to even keep my money invested. I mean, there's no doubt about that. But the people that make the most money, again, are the people that invest for the long term and the people that invest on financials, not emotions. You're reading the numbers. You're studying what's going on, and you cut out the noise. The media is in the business of selling hype. They always say that the world is either ending or nothing can go wrong. They're speaking in these extremes because they're trying to sell emotion. That's how they get people to watch them. So what you want to do is be an investor. Know what you want to buy it. If it goes down, buy more, but make sure you keep doing your research, analyze the numbers, make sure it makes sense financially, and if it does, then that's what you want to keep buying because you understand the numbers and you believe this is the company that's innovating for the future. And sometimes you might be wrong, but you're never going to be right unless you take the first step of starting.
So when should you start? When should you become an investor?
As soon as possible. Time is the most valuable thing when it comes to investing your money. And time gives you not only the opportunity for the company to grow, that way they can build and make your investment more valuable, but it also gives you time for your money to compound. So you start making money, you keep investing money, and as your investments make you more money, you take this profit that you earned and reinvest it back into there. So you start building the snowball where you keep adding on more snow, like every week, every month, you keep adding more money into it every time you get paid. And now as the snowball grows, becomes bigger, you're reinvesting the profits. That way you can have a bigger snowball working to earn you more money. So you want to start investing early. The sooner, the better. Do not wait. When you see dips, you see crashes, you see corrections, those are opportunities for you to come in and buy. Don't be like the majority who's running and selling. I mean, if your company is on the verge of bankruptcy, if your company is seriously struggling, then yeah, you want to be selling. But if you have a strong company, or if you find companies that you believe in, those are great opportunities for you to come in and buy. And then you want to hold for the long term. Answer your questions?
That's perfect. I think I'm ready to go.
All right, let's go. Let's start investing in stocks. So there you have it. Everything you need to know when it comes down to investing your money in stocks, especially this year in this crazy market. So Hope you enjoyed this video. If you want to see more like this, leave us a comment in the description. If you want to see more of Nate, check out the Minority Mindset News channel. He's releasing videos every single day, multiple times a day, of things you need to know of what's going on in the finance and business world. So make sure you subscribe to the Minority Mindset News channel. I am Jaspreet Singh, and as always, keep hustling. In 2021, the GDP is expected to be something around $21.95 trillion, which is right around a 4.85% increase since 2020. So what you can see is your GDP is growing, but not as fast as our national debt.